Welcome back to More Fun with Finance. I'm Dr. William Elliott coming to you from my studio in beautiful uptown Shaker Heights. So this chapter, chapter 4, is kind of a continuation looking at financial statements, and in particular with regard to long-term growth. And for that, we're going to need this device called a pro forma financial statement. And pro forma simply meaning of the form. And what it means when we talk about it in the context of financial planning is we're projecting into the future what the financial statements are going to look like. This is important because these financial statements are really kind of a picture, the basic picture of what the firm's health is and where we might have problems, might need additional capital, might need additional assets, and so forth to engage in the work that is to be done over the next year to 5 years or so. Typically, projections don't go out past about 5 years simply because the uncertainty is so much higher out there. But in any case, that's what this chapter is focused on, and we will, let me jump over to the slide deck and get out of the way. And let's get started here. Well, let me just touch on this just so that you know where we're headed. Basically, we're going to talk a little bit about what financial planning is. We're going to look at a variety of examples using different companies. We're going to create some pro forma financial statements using the percent of sales method. It's one of the simpler methods. There are some more detailed methods, but at this point in your learning about finance, in your path to learn about finance, we don't need to go any deeper than that. Then from that percent of sales pro forma, we'll discover whether we have any external financing needs, and we'll also look at how quickly the company can grow without adding any additional debt and equity and or just no additional equity. All right, so that's the basic plan. So financial planning is concerned with the major elements of how does the firm go from where it is today to where it is going to be in the next year to 5 years. We're going to look at specifically investment needs in the assets, and then we're going to look at, that's one side of it, right? That's the left-hand side of the balance sheet. Then we're going to look at the right-hand side of the balance sheet. How do we finance these things? Do we need additional debt? Do we need additional equity? Do we need a little of each? Do we need none? We're also wanting to think about the amount of net working capital, amount of cash that we'll need, things of that nature. So, growth by itself is not an appropriate goal. We really need to look at the market value of the firm as it pertains to growth. Really super high growth rates don't necessarily mean it's a good firm. It's more than likely going to run into some problems and could very possibly fail if it grows too quickly, losing some of the essence that made it of value when it was growing at a slower rate. So it's not growth at no expense. It's growth that is defined and is reasonable and is attainable. So we're going to look at what is the planning horizon. Is it 1 year, 2 year, 5 years? We're also going to aggregate the investment proposals for each firm into kind of a overall investment proposal for the entire firm. And we're going to look at the various inputs to that. All right. We want to examine the interactions between the various accounts on our balance sheet and our income statement. This is crucial that we understand that, and we're going to start with a very kind of naive percent of sales growth pro forma financial statements, which don't really correctly acknowledge the interactions. Let me just give you an example of what we're talking about to make it a bit more concrete. So for example, if I have a plant that is running at 70% of capacity and I want to increase my sales by 10%, do I need to increase the size of the plant? And very likely the answer is no, because that plant has 30% additional capacity. Now, Will we actually be able to get to 100%? Things of that. Those questions are different. But if we're only adding 10%, more than likely our fixed assets can remain the same. Now we might need to add a little bit more in for maintenance and repair and things of that nature, simply because as we're pushing closer to utilizing the plant and equipment at closer to maximum capacity, we're probably going to run into additional costs. Think about driving your car. If you just drive around at 20 miles an hour, you can drive forever. If you push the limit of your car, it's very likely that you can damage your engine and cause it to have a shorter life. So it's that sort of thing. Also want to look at different options. How could we achieve the same set of goals and growth in our sales with maybe different leverages, maybe different resources on the asset side. We also want to try to avoid any sort of surprises. We want to ensure that that it is feasible to do this, that we can hire the additional people we might need, that we can train them, that they can be up and running in a reasonable time. One other thing that is not mentioned here in the text, and let me grab my pencil here, and that is another thing we should consider, and this is something we won't actually touch on in this chapter, but I want to point it out to you, is this thing called real options. Real options are a very interesting aspect of financial planning that is only recently become popular and is being more frequently used by firms. Remember, anytime we talk about how firms plan, how firms operate, we're always talking about firms that are run by people who have been through business school 20, 30, 40 years ago. Just a brief example. I worked at Glastron Boat Company back in the 80s and was a engineering manager for the company. It was a relatively small company, so I was able to interact with the executives and all the way up to the CEO on a fairly regular basis. We're on a first name basis. I had a project that at that time we were cutting the wooden parts for the fiberglass boats that we built. There's a lot of wood in fiberglass boats, surprisingly. But we were cutting those parts with these big machines called pin routers. And we had a pattern, and that pattern would be placed on top of several sheets of plywood, and a person would move that plywood around, move the pin router, and route each of the parts, and then they would be dipped into a preservative and put on a shelf. I suggested at that time that we should consider looking at CNC, computer numeric control machines, instead of these old-fashioned pin routers, which had been around for decades and decades. CNC was just coming to the industry at that point in time. And I looked at the numbers, I looked at the labor savings, I looked at the inventory reduction that we would enjoy by using CNC, and presented it to the executive management. Well, guess what? They didn't use the MPV rule at Glastron at that time. They used a payback rule, and it had to be a payback in 2 years. Full payback. Now, at that time, these CNC routers were extraordinarily expensive and fairly large pieces of equipment. You could not get them for what I could not make the numbers work for a 2-year payback. So they passed on the project. CEO and part owner of the company, Keith Orm, decided, no, this is not something we want to do. Now, it turns out that the entire boating industry moved to that in about another 10 years, but we were slow to do it, and we actually lost our competitive edge partly as a result of that. There were other things going on there, too, that were dated and that other companies eclipsed us. But that's an example of management not understanding what's actually being studied and taught in the current curriculum of business schools. Real options, back to this, real options are another one of those things. So again, just a very brief discussion about what a real option is. A real option is while you're doing a project, if the project doesn't seem to be going the way you're expecting it to go, what can you do? Well, one thing you can do is simply abandon the project. And we call that the abandonment option. So in other words, you don't lose all of the money if the project doesn't look like it's successful or moving in the direction you wanted it or expected it to move, then you just simply shut it down at this point and you save any potential losses that might have occurred in the future. That has real value. It's an option because we can choose to do it or not based upon the current information at that time. Another real option is the expansion option. So suppose that we have a project and it looks like it's actually going well, maybe even better than we expected. We can expand it, maybe double the scale of what we're doing. Some real world examples. The classic one of a expansion option is Coca-Cola when it first went into China with its products. It was very doubtful that those products would necessarily catch on given the culture in China at that time. It was very much a different type of beverage, typically a tea, things of that nature. A sugary, carbonated soft drink was not something that was a go-to. But Coca-Cola thought, okay, we want to be a first mover. We're already the biggest, in the U.S. We want to be a first mover in other countries, so we better get in there, kind of dip our toes in the water and see what it's like. Well, actually, when they did, it actually turned out that there was a demand for that. And as that demand revealed itself, then the company continued to expand and expand and expand. Until its footprint is what you see today, which is quite a bit of their revenues are generated from China. Anyway, I just wanted to point this out to you and add that to the list of items here that we should be thinking about when we talk about long-term financial planning. All right, so we're going to need a few things when we get started. One of the primary things we're going to need here is a sales forecast. Where do we get that? Well, typically we're going to work with our marketing department, a sales group, and try to figure out what's potentially out there, how much additional demand is there that we have not fully realized, and how quickly can we access that demand. We're going to need to put together some pro forma financial statements so that we have a good look at what sort of external financing needs we might have in the future. And by external financing needs, that's usually abbreviated EFN. So you're going to see that frequently throughout this chapter. The external financing needs are basically, do we need to raise more debt? Do we need to issue more bonds? Do we need to do a stock issue in order to raise additional capital to fund the purchase of assets, whether they're current assets or whether they're long-term assets? And that brings us to the next point, which is asset requirements. What do we need in terms of additional assets? First off, obviously, working capital is probably going to go up if we're expanding our sales, if we're increasing our revenue. But what about fixed assets? That's always the big question. Financial requirements. What do we need in terms of the financing, that EFN? And what are we going to do in terms of dividend policy? That is the payout that we give to shareholders. Are we going to continue with it? Are we going to continue to grow it? Depends on the financial needs of the firm. And then there's this thing that the authors call a plug figure. Basically what that means is, and you'll see this when we get into the pro formas, but the balance sheet has to balance, right? The left-hand side has to balance with the right-hand side. And if we're changing the working capital and not changing all of the fixed assets, maybe adding a little bit to it, but not the full amount of the increase in the sales. Also, we don't forget, when we come down to net income, whatever doesn't get paid out as dividends or stock repurchase gets transferred over to the right-hand side of the balance sheet and increases the account value for the equity stake. So those things are going on. They're going to cause the balance sheet to go out of balance, and we need some way of plugging in a number to make it balance. Typically, that's going to be on the long-term debt side or possibly an additional equity issue. It might be the reverse too. Actually, if we have a lot of excess internally generated funds, we might actually be able to pay down some of the debt or do more buybacks in terms of the equity. And then lastly, we need some sort of economic projections to look at. Is the economy in the growth stage? Is it contracting? Is it reached a peak? Has it reached a trough? That sort of thing is good to know so that we can depend upon that sales forecast. If the economy is about to go into the tank or appears to go into the tank, maybe a sales forecast of an increase of 20% over the next year is just completely unrealistic, and so why bother? But all of these elements go into the financial plan. We're going to be focusing predominantly on this pro forma piece, the asset requirements, and the financial requirements, and the plug. The sales forecast we're going to take as a given, and the economic assumptions we're going to take as already having been considered. All right, so let's start off with this first example here. This is Westerfield Corporation, and I'm going to jump out of the way here so that you can see the entire slide. So here we have Westerfield Corporation's financial statements from the most recent year. We have a sales, an income statement with sales of $1 million, costs of $800,000, and I'm assuming that these are in thousands. And then that leaves us with a net income of $200,000. Over on the balance sheet, we have $500,000 in assets, and we have that financed with half of it's financed with debt to the tune of $250,000. The other half is financed with equity, another $250,000, giving us $500,000 on both sides. So our balance sheet is in good shape. Now, the sales forecast is that we're going to be able to increase our sales by 20%. So that will take us from $1 million up to $1.2 million in sales. All right. We're also assuming that costs are going to go up directly with sales. So costs were 80% of sales. We're going to assume that in the next year, they're also going to be 80% of sales. So 80% of $1,200 is $960,000. So now we can construct our pro forma income statement, and we've got sales of 1.2 million, and we have costs of 960,000 for a net income of 240,000. We can also construct our pro forma balance sheet with one additional assumption, which is not stated on the slide, but we're assuming that we're going to increase all of the assets by the same amount of sales. In other words, the underlying assumption here is that our plant, property, and equipment is at 100%, and that we can scale up by 20%, all of that, including both current assets as well as long-term or fixed assets. So we're going to go from 500 up to 600. And then on the debt and equity side of it, we're going to say, okay, well, we'll keep the same financial structure for the moment. Hold that thought. And we're going to have 300 of equity and 300 in debt financing for a total of 600. So again, our balance sheet is in balance. Now, however, what about, let's go back and look at this balance sheet for just a minute. Let me draw your attention to the equity line here. The equity stake has only gone up by $50,000 in this particular situation. But we've got a net income of $240,000. And if the equity only goes up by $50,000, remember, anytime let me just back up to here. When we look at our net income at the end of the year, when we close our books out, that net income, anything that hasn't been paid out in the form of a dividend or a stock repurchase, gets bumped over here and put into the retained earnings account under the equity side of the balance sheet. So what they're saying here is that if we only see 50,000 showing up on equity as an increase to equity, that means we must have paid out 190,000 as a dividend. Well, the question then is, what dividend do we typically pay in this company? Is it 190,000 divided by the number of shares? Obviously, that would be dividend per share. Or is it less? And so we're going to have to look at dividends. And I don't want to get into too deep a discussion of dividends, but let me just leave it at this for the moment. And as you go through not only this course, but the second course in finance, corporate finance, you'll come to see that dividends, a dividend stream is typically kept very, very stable. So companies, if they are paying a dividend, they're going to try desperately to continue to pay that same dividend. And if they're not paying a dividend, they more than likely will not start unless they have a great deal of excess cash flow that they'd like to return to the shareholders. They don't have any other positive NPV projects, so they'll return it to the shareholders. All right, so let's go down. Suppose that Computerfield does not pay out the 190,000, and actually let's assume that they don't even pay a dividend, so they're not going to decide to start all of a sudden. So let's say that entire 240,000 goes over onto the balance sheet into retained earnings. So equity will grow from 250 all the way up to 490,000. If we have 490 in the equity account and we have a total of 600,000 in assets, we're only going to need 110,000 in debt. So that means we're going to be repaying or paying back to the bondholders 140,000. And that's denoted right down here. So an updated balance sheet would suggest a very different picture. Now, what this has done effectively is to reduce the financial leverage. What do you think? Is that problematic? Think back to the prior chapter. And in particular, think about the DuPont analysis or ROE decomposition. What were those three elements? Well, there was a profit margin in there, right? There was a measure of efficient use of assets. And, oh yeah, that third one, the all-important equity multiplier. That is the measure of leverage. So if we reduce our leverage, we're actually going to be reducing our ROE. Is that something we want to do? I don't know. I mean, that's up to the firm. Now, this is a topic for much greater depth discussion later on in the class and in your second semester of corporate finance. But a shorthand here is that there's usually some sort of optimal, or at least we think of some sort of optimal amount of debt for a particular firm or for a particular industry. And maybe we've dropped well below that. And if we're below the optimal, that means that we might be decreasing the market value of our firm. So we want to be very careful about how we deal with this. One additional alternative that isn't mentioned here is maybe instead of paying a dividend, maybe we do a stock buyback with 100 million. And that means that of that 240 million, only 140 million of it goes over to the retained earnings account on the equity portion of the balance sheet, meaning that we don't decrease our financial leverage by as much. Anyway, all good things to keep in mind. All right, so let's kind of, we've already made some allusion, or we've already talked a little bit about this percent of sales. In fact, we've actually used it in an example already, but now let's go into more detail. So basically, what this percent of sales method says is that not only many of the items on the income statement, but many or most of the items on the balance sheet will vary directly with the level of sales. When it comes to cost of goods sold, that makes sense. If the input is 50 cents and we sell something for $1, if we sell two of them, we're going to need another 50 cents in costs, right? The costs are going to double. Same thing with labor. Now, SG&A, that may not be directly, interest may not either, but in general, a very simplified approach says let's assume that it does. On the balance sheet side, as I've already mentioned earlier in this chapter, not all of that is as easily dealt with. Certainly, current assets and current liabilities will probably go up spontaneously with the level of sales, but maybe not so much with fixed assets. And then we have to remember that we've got that net income that isn't paid out to shareholders going across and adding to the equity portion of the balance sheet. So this percent of sales method is usually kind of a starting point, and then we adapt and we make various adjustments to the percent of sales method. Okay, here we have an income statement for another example, and this particular one is Rosengarten Corporation, and they projected a 25% increase in sales in the upcoming year, and that means that sales are going to go from, let's call it 1,000 to 1,250. And so the question then becomes, what happens to the rest of the financial statements? So we can also tell, we're also assuming that they're going to maintain the same cost of goods sold. So right now, 83.3% of the revenue is eaten up by cost of goods sold. So that's reflected right down here on the income statement. And then we get down to taxable income. This example, apparently there is no interest expense. And so then we drop down to taxes, and then we have a net income of $132. We're also told that they pay out $44 in dividends, leaving an $88 addition to retained earnings. We'll see that on the balance sheet. All right. So we can see that they have a 13.2% profit margin. That is 132 divided by 1,000. So here is our profit margin, and we're going to assume that also remains constant. Now we have to look at what do the dividends go up by. They've made the assumption here that we're going to pay out the same percentage amount of our income in the form of dividends. Now again, kind of a fast forward to future discussions on dividends. That's not always the case. This is just a simplifying assumption here. So you'll see why that is, but in the future when we have a deeper dive into dividends. But for the moment, basically what we see here is that they're paying out 1/3 of their income, of their net income, in the form of dividends. So that means that 2/3 of that net income goes to retained earnings, and you'll see that right down here. All right, good so far? Now, let's jump over to the balance sheet. On the balance sheet, we see that we currently have 160 in cash. That's 16% relative to sales. And remember, these percentages are relative to sales, not to total assets, but to sales. All right, we have accounts receivable, we've got inventory, and that gives us a total current assets of 1,200, or 120% of sales. And then we also have another 1,800 in fixed assets in plant, property, and equipment, giving us a total asset base of 3,000. Over here on the right-hand side, we've got current liabilities, predominantly accounts payable, and a little bit in notes payable. We've got a total of 400 in that. We have another 800 in long-term debt, and then we have an additional 1,800 in equity. So that gives us, again, that 3,000, and our balance sheet is balanced. All right. For the items that vary directly with sales, we've got a percentage. So right here, notice they're assuming that all of these vary directly with sales. Accounts payable varies directly with sales, but everything else, let me get out of the way so you can see that. All right. Everything else over here is going to be one of those plug figures that we talked about earlier. All right, so here is our pro forma, or our projected balance sheet for Rosengarten Corporation. Now we're still going to have a fair amount of cash, but that's going to go up by the percent of sales. So it's going to go from 160 to 200. Likewise, accounts receivable, same with inventory. So that's going to bring up our current assets to 1,500 instead of the 1,200 we had before. We're also assuming, in fact, this assumption is implicit in this, that we're already at 100% capacity, so we're going to have to expand our plant, property, and equipment. And the other interesting thing is that we're just expanding it by the amount of growth for next year. Now, again, back to the real world. In the real world, maybe we don't do that because we might have more growth the following year and the year after that. So, and it may not make sense to add 20% more plant. The fixed costs related to construction might cause us to say, well, let's not add 20%. Let's actually double our plant size. This is not a variable cost. It's not an item on the inventory that's sitting in the storeroom shelf somewhere. We're talking a major construction project, more than likely, with fairly major equipment. And so, we've got a machine that produces 1,000 widgets. There isn't a machine that only produces 200. We buy a second machine that produces another 1,000. So this actual estimate is not terribly realistic. I just want to point that out in case you were wondering. You're probably sitting there going, well, why did they do that? Right? All right, so this is going to leave us with $3,750 on the asset side. We had accounts payable varying directly with sales as well. We left notes payable the same. And so that means we have $475 in current liabilities. Then we've got long-term debt to deal with. That's $800. And we also have the equity side to deal with. That goes up spontaneously by 110. And remember, that 110 is the amount we did not pay out in the form of dividends, right? But everything else remains the same. And so what that does to us is that gives us a balance on the right-hand side of only $31.85, which is considerably lower than the amount of assets we need. So we've got to figure out some way of financing those additional assets. And it's actually, to be specific, it's $565 of additional assets that we need to finance. Where does that come from? All right, so we're going to look at three possible sources for this 565. We're going to look at short-term borrowing. We're going to look at long-term borrowing. We're going to look at a new equity issuance. Now, let's say that that's been analyzed and they've chosen to go with a combination of short-term borrowing and long-term debt. Now, you might say, well, why don't they do all three? And the answer to that question, and again, this is something we'll delve into at a much deeper level later in either this course or the second semester, and that is there are a lot of fixed costs associated, in particular with a bond issue and a new stock issue. So those fixed costs are the same regardless of whether we issue, $1 million or $50 million. So what we're trying to do is, with one project, we might use all equity, and that will lower our financial leverage. The next project will use debt, and that'll bring our financial leverage back up. Another thing to think about here is that we're usually, if we don't pay out everything in the form of dividends or a stock repurchase, we're usually adding equity to the balance sheet anyway. So it's not infrequent that the typical go-to is debt, because we're already adding equity, which is decreasing financial leverage. So by adding back debt, to finance these external financing needs, we actually maintain a smoother financial leverage over time. All right, so let's follow that prescription that they said we're going to do a blend of short-term and long-term debt. And so here's our accounts payable, same thing. We're upping our notes payable from 100 to 325. And that means that that's an additional 225 out of the 565. All right. And then finally, the other 340 is an increase in long-term debt. Now, when we get down here, you'll notice that the balance sheet does balance. And now we have our pro forma financial statement and a pro forma balance sheet. It just gives us a basic picture of the health of the firm if we take on this expansion project. An alternative scenario, I already mentioned this, but this makes the assumption that we're at 100% capacity. And if we aren't, then maybe we can expand without increasing fixed assets, which will reduce our external financing need. I'll leave this for you to walk through yourselves, but basically that's all that's happening on this slide. If we assume that we're at 70% capacity and we're currently selling $1,000 worth of items, what's full capacity sales? Well, it's simply 1,000 divided by 0.7 or 1429. So we could actually very easily, if this assumption is right, we could easily expand the firm with the additional sales and not change our fixed assets at all, which would reduce our external financing need. It would reduce this 3750 down to a substantially lower number. In fact, if we didn't do any expansion, it would decrease it by $450. All right. Again, this is just more talking about that full capacity sales and looking at the capital intensity ratio. I'm not going to bore you with going through these numbers, but I do recommend that you walk through this slide. But this is more or less the same sort of analysis here. This is assuming that we're at 90% capacity instead of 70, though. Keep that in mind as you read through this. At 90%, we could get up to 1111. That still means that we're going to need some additional assets if we're to increase our sales by 25%. Okay, so now growth in external financing. We're going to look at this example, and then we're going to go into some calculations that will allow us to understand what sort of internal rate of growth we can sustain without any additional financing, with any more financing from outside, just what we've generated from the prior years of sales. All right, we're going to look at Hoffman Company as another example, and then we're going to look at a couple of formulas that will help us to calculate the sustainable growth rate. That is the rate at which we can expand the firm without going to external markets, the debt market or the equity market. All right, so in Hoffman's case here, they have sales last year of 500, and they're increasing that to 600, or that's their goal. That's a 20% increase. We're also going to need an additional $100 worth of assets, according to their analysis, which means that we're going to be left with some external financing need. It's not going to be the entire $100 because 52.8 of those dollars are retained earnings. So that's internally financed. So that means that we just have this 47.2 that is the external financing. And then we have to decide, are we going to use debt or are we going to use equity? In this case, they've chosen to use debt. So our new equity balance is going to be the 250 plus 52.8, which gives us 302.8. Our new debt is going to be 250 plus 47.2, or 297.2, right? And that's illustrated down here as well. And then we can calculate the debt to equity ratio, which used to be 1 before this project, and we see that it's dropped a little bit. So we've reduced the leverage a tiny bit, not substantial enough to affect the overall performance of the firm, especially when we're looking at something like ROE. It's going to drop it a little bit because the equity multiplier decreases, but not by anything significant. Now, here we have an income statement and a balance sheet for the company prior to this new project. So the company was selling $500 worth of items with a cost of $416.50, and getting down here to the bottom line, after taxes, we had $66 in income. We're actually told here that we pay out a third of that in dividends. So we pay out $22 in dividends. That means that we have $44 to plow back into the firm, reinvest in the firm. And then here is the asset picture: 200 in current, 300 in fixed, and a total of 5. And that's financed with exactly half and half equity and debt. When we look at the pro forma financial statements, both income statement and balance sheet, here's the updated picture: 600 in sales. Cost of goods goes up by the same amount, and that ultimately leaves us with a net income of $79.2. 1/3 of that is approximately 26.4, leaving 52.8 as a contribution to retained earnings and reinvestment in the firm. When we look at the new balance sheet, we needed $100 of additional assets. That was split up between current, went up by 40, and fixed went up by 60. And over here on the right-hand side, you'll see the figures that we just calculated 2 slides back. All right? Everything good? Okay. We can look at various external financing needs as a function of growth. So here what they've done is they've said, well, let's look at different rates of growth. Here's the one that we just walked through. 20%, assets increased by 100. We have 52.8 in additional retained earnings, which means our external financing need is 100 minus 52.8. There's our 47.2. And then when we calculate a debt to equity ratio, we see that it's relatively unchanged. It goes down as we reduce the projected sales growth. So at 5% growth, we only need to increase the assets by 25. We actually have 46.2 contribution from retained earnings, meaning that we're actually able to pay back some debt, pay off some debt, or we could choose to retire equity. We could do a buyback, repurchase of equity. But if we chose to reduce the debt, that would reduce our debt to equity ratio down to 0.77. If the rate of growth in sales was higher, if it was 25%, that would require an additional 125 in assets. 55 would be the contribution from retained earnings, leaving us with a $70 need for external financing. And if we did that all with debt, that would raise our debt to equity ratio a little above 1.05. So these are the sorts of analyses that we can do, sensitivity analysis, right? It's helpful to know this in advance. That way we can pre-plan for a bond issue or for an equity issue or maybe a repurchase of equity. We can go to our investment banker and say, hey, look, here's the new project. Here's what we see as potential needs. Maybe they even say, hey, we think best case scenario is 20%, but there's some possibility we'll fall below that and only have 15. Some possibility we'll actually exceed that and be up to 25. Here are what our needs are in each of those scenarios. So this is always something that you would want to do as a analyst inside this firm, Hoffman Company. Now, on to talking about internal rate of growth. This is a way of calculating very simply how quickly can a firm grow without requiring additional debt or equity. And the formula is relatively simple. In this one, we're using ROA right there. B is what they call the plowback rate or the reinvestment rate. You can think of that as the amount of net income that gets reinvested into the firm, or you can think of it as 1 minus the payout rate. Payout rate is the amount of net income that gets paid to the shareholders, either in the form of dividends or in the form of a stock buyback or a stock repurchase. So all we need is ROA and payback, plowback. So in the case of Hoffman, they had net income of $66. Total assets were $500, and so we can calculate a ROA. 66 is the net income divided by total assets. We get an ROA of 13.2%. All right, and they paid out 1/3, so that means 1 minus that payout rate is the plowback ratio, or B, and that would be 2/3, or about 66, 67%. So when we plug in these numbers, what we see here is that without adding any additional external financing, the company can grow at just slightly under 10% every year, just as a result of its operations, which is it's a good thing to know. There's one other direction we could go here, and that is, let's assume that we're not going to issue any additional equity, but let's assume that we could issue some additional debt. So that is called sustainable growth rate, right? This is just simply internal growth rate, and that is don't issue any debt or equity. The sustainable growth rate is just don't issue any additional equity. Okay, when we get to sustainable growth rate, that differs, remember, from internal growth rate in that sustainable, we're only holding equity without doing any issues. In other words, we can issue debt, whereas in internal, we said we weren't going to issue equity or debt, neither one. So sustainable obviously is going to generate a higher growth rate than internal rate of growth. And we also, you'll notice the formula here is real similar, but instead of ROA, we're using ROE here. B is still the plowback ratio, and that's going to remain the same. In this case, when we calculate ROA, or ROE rather, it's 66. That would be our net income divided by the amount of equity, which is 250. So that gives us an ROE of 26.4% rather than the 13.2. All right, so now we just plug and chug again. Be careful of order of operations. We end up with 21.11%, so considerably higher, almost a little more than double the rate of internal growth. The sustainable growth rate allows us to grow at 21, slightly over 21%. Now, some of the determinants of growth, obviously, profit margin is going to be an important element here, and are we going to be able to maintain that? Dividend policy is going to affect how much of the funds get plowed back into the firm versus get paid out to shareholders. Leverage or financial policy is going to matter a great deal too. Are we at the optimal? Are we moving toward it? Coming down? Are we trying to reduce leverage, increase leverage? What are we doing there? That's going to affect how we adjust our balance sheet. What sort of efficiency do we have? That's the total asset turnover. Maybe we're planning on becoming a bit more efficient in our use of assets. And so all of these things come together and help us to understand how fast we can grow. And maybe the firm says we're not going to issue any debt, or we're not going to issue any equity. We're only going to grow within our internal growth rate, and that's going to affect what we can sustain from a sales perspective. Some caveats, probably the biggest one here is this cash flow. We're using accounting financial statements, and thus we're not actually calculating a cash flow. Clearly, we should do this at some point before engaging in the project to make sure that we know we have sufficient financing on an ongoing basis. It doesn't factor in risk necessarily, nor timing directly of all of these expenditures. We're assuming everything occurs sometime over that course of that year. So those are some of the more complicated issues to deal with, but remember, this is just an introduction to corporate finance, so we're not going to deal with those in this particular chapter. And that wraps things up for Chapter 4. Thanks very much. Bye-bye.